Let's get more on the investment outlook for the industry from a tech fund manager who oversees more than £1 billion. Ben Rogoff is in charge of the technology trust at Polar Capital Partners and joins us now. Good morning to you.
Morning.
Those figures from Oracle, a blip or a worrying trend?
Not sure at this stage. I think we had last night another software company report, TIBCO, came up with some pretty good numbers, talked about the macro environment not really impacting them in the same way that Oracle suggested they were. So, but I think it's fair to say that Oracle is an industry proxy, and I think it was a genuinely worrying development, the fact that they missed across the board the day before.
And a worrying development that maybe people are putting off key decisions, notably in investment in software, because of what's the main reason?
Well, macro uncertainty. I mean, I think the thing is, the software space, and let's be clear, it's the end of the year. I think stock moves have been exaggerated because here we are in December and volumes typically lighten up and people are away from their desks. So I personally don't feel it was quite as bad as necessarily the stock prices suggested. But yes, software has been a place where investors such as myself have been hiding from some of the macro kind of problems because they're famously late cycle. And so the Oracle disappointment, it's a kind of harbinger of, or maybe finally, some of the difficulty and uncertainty in Europe is beginning to result in extended sales cycles as to how Oracle explained it.
You're not invested in Europe, are you?
I have a modest amount.
Not much, though. I mean, you're avoiding it, right?
I think there's just a very limited universe of technology companies in Europe that we feel are kind of world-class. So we have about 8% of our portfolio in Europe.
We're told a lot of the tech sector, to a certain extent, is resilient to some of the problems that are going on in the world. That might be true with the likes of Apple and IBM.
Will it be all
smaller companies?
Oh, I see. Well, I think Oracle, so just before we finish on that, I think one of the other reasons why the Oracle reaction was what it was that over the course of this year, really investors have been running toward what I call stores of wealth, mega-cap stores of wealth, because they're so uncertain about the world that, how badly wrong can you go in an IBM or an Apple or an Oracle? And one of our senses is that as we go into next year, if things improve a little, that some of that kind of scarcity value of those mega caps should unwind. And I think that Oracle reaction. So IBM and Apple, I think both companies are in pretty good shape, frankly.
But are you reducing your stake in Apple?
Well, I have been taking, at the margin, sad passing of Steve Jobs, we took a little bit off the table there just on the basis of execution risk. We still love the story. It's still by far the biggest position in both our portfolios. In the case of IBM, I think that's turned into a cult stock this year. Warren Buffett obviously made an investment, his first proper foray into tech for a very long time, if ever. And I think that's created cult status in a stock that, frankly, now trades at a 2 to 3 point P premium to Oracle, despite over the fact that the last 5 years the companies have grown earnings roughly in line. So I look at the IBM and think, actually, that has a lot to lose, and so we've been reducing that quite materially.
Research in Motion has lost about 3/4 of its value. Now, you have bought a small amount of that stock, haven't you? Do you regret that?
For my sins. Oh, do I regret it? Well, I bought some at around 17, so given that it's at 14 or thereabouts, the answer is a yes.
But what does the future hold for this company?
Well, it's unsure, but the reason that I made even a very, by the way, very modest foray, 20 basis points, the reason that we went back to the stock having sold it at 27 was that, the company has a nice balance sheet, it has a patent portfolio that's as long as its arm.
So it could be right for a takeover target.
To be frank, I think if it wasn't Canadian and didn't have joint CEOs, it would have been bought by now.
Sure.
So I think there's a whole bunch of suitors for the company, and that's why I covered the position in the index.
Google is your second biggest holding, I think, in your fund. What does it have to do to impress you next year? Because it has been quite a topsy-turvy year for Google.
It has. I mean, to be frank, again, another mega-cap store of wealth, and so it's been a very good holding for us relative to the average technology stock this year. I think at the margin, I'm kind of getting into a slightly lightening position and looking to redistribute that into names like yesterday, a whole bunch of software companies that were just taken out and chucked out with the Oracle news. So what do they have to do? They have to deliver growth, obviously. They have to deliver mid-teens revenue growth, some leverage on the bottom line. They have to desist from doing any more, M&A like they did with Motorola over the course of 2011. If they can do that, I think the stock will be a very solid performer.
And very, very briefly, Ben, we're out of time. What about your fund? How are you going to change the way that you do business to get it improving a bit better?
Well, I'm not quite sure how to take that. I mean, look, we've had a trickier year because the market's been tricky, but we've had 2 stellar years the 2 years before. I think the way to look at it is we still think that the financial crisis, the worst of it will abate over the coming year. As a result, take down large cap exposure, increase small and mid cap, and look for a new generation of tech companies to outperform.
And keep your fingers crossed.
A little bit.
Ben Rogoff, Technology Fund Manager at Polar Capital Partners. I'm grateful to you.